let's take it for an example, IBM. And I'm going to go to my screen just for a second, and I'm going to show you what an option contract is selling for IBM. We'll go down here to options. We'll take a look at the current month of options, which is May. Now remember, option contracts will fluctuate in price and expire at a certain date. Almost all option contracts expire the third week of the month in which they're being written. So the May contracts will expire the third Friday of the month in May. That is the last day that you can trade those contracts. At the close of business on the third Friday of May, you will no longer be able to trade those contracts, and the contracts will expire the very next day. So you're going to, let's take this May of 2008 90 price strike price option. If you were to buy a call option, you would buy it at $34.80. You can also sell a contract. In other words, just like the property owner, even though you do not own the stock, but the market gives you the right to sell a contract on a stock that you do not own. And you could sell that contract for $34.10. So, in other words, you can collect the premium, just like the option buyer who came to your property and gave you a $500 premium. You would collect that $34.10 on that option contract, and you get to keep it as long as the price of IBM goes below $90. Is at $90 or below. That's what makes option trading so much more flexible, because you can both be a writer of options and a buyer of options at the same time. And there's all kinds of strategies that you can use in order to profit not only from the expiration date of these options, but also from the fluctuation in the prices themselves. Most people who are speculators in the market buy what we call at-the-money options. So right now, IBM is trading at $124.40. The closest option to that price is the 125 option. And the 125 option is right now, if you wanted to buy it, it's $2.80. So a single contract, if you were to purchase a call option on IBM at the 125 strike price, you would pay $2.80 for one contract. However, one contract gives you the right to purchase 100 shares of IBM stock. So if you were to purchase one contract, let's just click on that as a buy, and we'll toggle this down to one contract. One contract of the 125 call option on the May expiration of IBM would cost you $280, because you are actually purchasing the right to buy not one share of IBM, but one contract equals 100 shares of IBM. So whatever the price of that option is, $2.80, you would have to multiply by 100 in order to determine your exact cost. So including your commissions of $2.95 for one contract, your total cost is $282.95. Now, how would you determine whether or not you would ever make a profit? Well, if IBM stock rose in price, okay, let's say it went up $5 tomorrow, and that's a distinct possibility, because IBM does move pretty quickly, and it does move in sometimes large numbers. What would the price, how would you determine the price of the contract of the 125 strike price? See, if you purchase one contract of this May 08 125 contract on IBM, that gives you the right to purchase IBM at $125. Okay? The premium that you're paying, the $280 for that one contract, that one option contract that gives you the right to buy 100 shares of IBM, will expire the third week of May, the third Friday of May to be specific. So right now you're purchasing the right but not the obligation to purchase IBM at $125. Now what happens if you're right and IBM does increase in price? Let's say it goes all the way up to $145. Well, if it's at $145, you, as long as it's at $145 before the third Friday of May, you have the right to purchase the stock, 100 shares of stock, if you purchase one contract at $125. Cool, right? Because you could immediately exercise your option. All you have to do is sell your option at $125 and pocket the difference between $125 and $145 that the stock is currently trading at. That's $20 of profit. However, you don't keep all $20 of that profit because you paid $2.80 for that premium. You gave that to the seller of that option, and they get to keep that no matter what the current price is. So if your stock goes from $125 to $145, that's a $20 difference minus the $2.80 that you paid. So you've actually made a profit of $17.20. Okay? So, but what if tomorrow, what happens tomorrow if actually most people don't hold options that long? In fact, many people who are buying the at-the-money options for IBM or any other stock that has active options on it will hold it for just a few days. What happens if IBM goes up to $130 tomorrow? Well, you can simply take a look at what happens to this option if it goes $5 further in the money. And all of these options on this gray bluish screen are in the money. That means that the options are trading at a strike price below the current price of the stock. So if IBM were to go up $5 tomorrow to $130, then it's more than likely that all of these options here will shift to a higher price. So in other words, that 125 now will be in the money the same as this 120 is now because there's still a $5 difference between the two. So your $2.80 option will go to $6. So, but if you wanted to try to sell it, you'd get $5.80. So what's the difference between $5.80 and $2.80? $3. And that would be your profit if IBM went up tomorrow to $130.